Hello, everyone. It's really great to be here. I'm Heidi Moore, and I'm talking with Fabrice Grinda. He is a super angel, and we're going to be talking today about how he invests and his advice for entrepreneurs, a look at the global VC industry, and I think it'll be really interesting. Thanks for being here.
Glad to be here.
So my first question is, you have a home in New York, and for most people, maybe that wouldn't be such a problem in your business. But tell me a little bit about how you came to have a home because you didn't for a while.
Well, I used to have a home, and back in 2012, I felt that I didn't like the way my life was evolving. In the sense that all of a sudden, when you own things, I had a country house in Bedford, I had a beautiful penthouse apartment in Manhattan, I had a car, I had all the trappings of success. But when you own things, I realized they kind of own you. If you have a place, you feel obligated to go to, and I'm spending so much money on the country house, so I go there every weekend. And at the same time, as my friends were getting older and they were all married and having kids, they're all busy with work, I realized the nature of friendships was changing. All of a sudden, I felt, instead of seeing them every day and we're remaking the world and talking about philosophy, we would meet each other every 6 weeks, and it'd be like, oh, in the last 6 weeks since I last met you, this is my biographical update. This is what happened to my kids, my husband, or my wife, and my job. And while it was still interesting, it didn't have the same texture and depth and the friendships had when we were in our 20s or early 30s and we were like spending all our time together. And so I'm like, you know what? What if I actually get rid of all my material possessions, my home, my apartment, my car, everything I own, give it all to charity, go down to 50 items that all fit in my carry-on, and now think through, okay, now in a world of infinite possibilities where I could be anywhere, stay with anyone, where do I actually really want to be? And I realized in that world that the amount of time I actually would want to spend at a place that was my country house was a lot lower than the time I was spending, and that I want to spend a lot more time with my friends. Now, part of it was a bit of a disaster. The first 6 months, I decided to couch surf on their couches, and Benjamin Franklin once said that house guests like fish start smelling after 3 days. He was very right. The problem is embedding myself in their life while they were not changing their life, where they still need to take the kids to school and go to work and come home, etc., doesn't really work. I'm actually a burden as opposed to there's a time to reconnect. And so that didn't work because I'm super high energy, and my vision of this was like, oh, we're gonna play tennis from 8 to 10 p.m. We're gonna have drinks and catch up from 10 to midnight, and then I can do whatever, read or write from 10 midnight to 2 a.m. But it's not the way most people's lives work, and so that fundamental disconnect didn't work. So ultimately, what I iterated to is inviting all my friends to join me on vacation a couple times a year at places that are easy to get to during the school year, during the school vacations, with like nannies organized where we can actually reconnect in the good old-fashioned way. And I realized actually I liked living in hotels and Airbnbs for 4 years, and I frankly would have continued to do that. Except that the U.S. economy is really hot, frankly, and the New York economy and the San Francisco economy is really hot. Everything got full, and so it got to the point where every 3 days I was changing hotels, I was changing Airbnb, and that created a transaction cost of its own, and that wasn't the point. The entire point of this is like free up time to do things that I like. So 2 years ago, I got an apartment in the Lower East Side, which has been amazing, and it actually has allowed me to restart some of the things that I lost by not having a home, especially organizing these intellectual salons where I invite public intellectuals and people from academia, thinkers, and people from all walks of life to debate different topics in a structured format where only one person can talk at a time about whatever the assigned topic is. And the topic could be anything from religion in 2100 to the ethics and morality of torture to how to deal with the refugee crisis. And I found that those are easier to have in a home that you're hosting, especially people that are maybe a bit more public or public intellectuals are more comfortable doing that than going to great places. So yeah, I now have a home in the Lower East Side, though I'm still a minimalist and own almost nothing, and it's been great.
Yeah, that's great. You don't make a big deal about it, but you did grow up in France, and so the idea of having a salon in your home is very French, right?
It's interesting that it's true that having intellectual salons comes from the 18th century intellectual tradition of the Enlightenment, and it was prototypically French. Though I haven't seen it be as common of late in France. And in fact, more of my friends in New York, San Francisco, are actually hosting these types of salons than my friends in France.
Yeah, I went to Paris last year and I hosted one, and everyone thought it was highly unusual. So I think you're right. Now you mentioned that you're high energy. I would call that an understatement, right? So just by the numbers, you said you read 100 books a year. You start 1 or 2 companies of your own. You invest in another 400 companies. Is that?
Well, per year in 50 to 100 companies, but a total of invested in 400 companies.
Yeah.
Yeah.
So just enormous numbers. So kind of talk a little bit about how, just in the most basic level, how you manage your time, because I think people could find that inspiring. And then also how having so much on your plate can give you energy rather than draining it.
So the way I manage my time is I realize that there are things in life that I love doing and there are things in life I hate doing. And I've just essentially outsourced everything that I hate doing. So I work with virtual assistants in the Philippines who manage my entire agenda. I don't cook, I don't clean, I don't like any, but if you actually get utility out of like cooking because you love cooking, you should totally do it. But in my case, I've like thought through, okay, what are the things in life that I like doing, and let's allocate my time to that, and then let's structure all of the rest of my life to not do it. And you can outsource more than you think, even to people that are remote, from booking restaurants to making recommendations to scheduling, frankly, your entire agenda. And I realized that if I structure my agenda with choices, even if I book, free time, or I book for video game playing time because I want to play video games from X to Z, this time period to this time period, it makes me more efficient. So breaking down the time that I spend into chunks that are bite-sized that increases productivity. Every night, for instance, let's say I go home at 8 p.m. and I go to bed at 2 a.m. This is 6 hours of time, and it's a lot of time. And the problem is many people, because they don't think of scheduling it, they're home, they turn the TV on, before you know it, like 3 hours have gone by. Now, there's nothing wrong with TV. I actually love TV and when it comes to, like, especially the media that's being generated by the Netflixes and HBOs of the world. So I want to watch Westworld and Game of Thrones. But it's a very different behavior to say, I love Westworld, therefore I'm going to go and watch it and make a time out of it, versus, like, I just turn the TV on and, like, a bunch of hours have gone by. And so by scheduling my time, including my free time, I can do so much more. So a typical evening could be, I'll go to the gym from 8 to 9. I'll go see a friend from 9 to 10:30 p.m. Maybe I'll play tennis from 10:30 to midnight. And then I'll read from 12 to 1, or write a blog post, or play video games. And so by scheduling all these activities, it allows you to maximize the amount of things you do. Now, I happen to be high energy and like diversity and value diversity and diversity of activities, and so that works for me. But the idea of scheduling your time, outsourcing everything you don't like doing, which is actually easier to do than you can think. And frankly, even in the context of my professional life, I have a partner who's amazing, and he really compliments me. Like, if I read a legal document, I fall asleep, like within word 2, and I would be terrible at doing that. And so I have a partner who takes care of all the back office, all of the legal work, all of the things that, frankly, I'm horrible at doing and hate doing.
Mm-hmm. So if you were take yourself back to when you were a young entrepreneur starting out, and what are the differences between how you thought about your time then and how you think about it now? What bad habits did you drop, and which good habits did you pick up?
Well, when I was, I started my first startup when I was 23, my first large startup. And the issue is because I lacked experience, I was overcompensating that by doing too much in a way. And so I didn't delegate nearly as much as I should. I didn't hire, and partly because I also didn't hire the right people. And so finding that you can hire like functional experts for each category, like the CFO has to be way better than I am at finance, and the CMO has to be a lot better than me at marketing, et cetera, that whom I can totally trust and to deliver allows me to just make sure that we're going to set the right strategic direction and make sure that we're executing on the strategy that's been set, rather than like going down into the weeds to the point where it was counterproductive. And so I was overly micromanaging the people, partly because I didn't hire the right people, and also but out of lack of maybe confidence or experience, and I wanted to make sure that everything was perfect.
Yeah, and so what did you find about hiring the right people? Because that's a major issue in Silicon Valley, in tech, even globally, is the right human resources that people are just now thinking about these issues of culture, of fit. How did you learn what kind of person would click?
I'll give you two different strategies for doing this. So a lot of the things I outsource, for instance, were like market research. I outsource on Upwork. Or if I take a lot of photos of a trip and I want to create a photo album, I also outsource that on Upwork. So a lot of these things, like creating videos, doing market research for a given industry, all these things are outsourceable, and I use Upwork for a lot of those. It's actually really painful to go and hire to interview 25 people to find this. So what I typically do is actually hire 7 people or 10 people to do the exact same amount of work. And then I see who does the work well, and then I just keep working with them on a regular basis. And so from that perspective of the lower level time, because it's $5 an hour, $10 an hour, $15 an hour, even though I'm overpaying 5x or 10x, it's relatively little dollars. It allows me to identify great people without spending that much time. And I value my time more than I value the overpayment in the early stages of that work. In terms of hiring great people here, for instance, so we have this really cool program, an apprenticeship program, where every year FJ Labs goes to Harvard, Stanford, MIT, Columbia, and Wharton Business School. We go to the first year students and we tell them, look, join us for the summer full time. We were going to train you to be venture capitalists. And during your second year, and we'll also put you part of the summer in one of the startups so you see what it's like to be an early stage startup. During the second year, where you're going to work 15, 20 hours a week, helping us filter deal flow. So you're going to see all the deals that we see. We see 100 deals a week. And when you graduate, together we're gonna create a company together where my partner Jose and I are going to be on your board. We're going to be co-founders, executive chairman. We'll give you the first $750,000. And you guys are going to be co-founders, co-CEOs, COOs, etc., and you get the vast majority of the equity. And so what's interesting is that last year we got about 200 applicants, we 215 applicants. All of them are actually amazing, right? Like these are the top people who have been entrepreneurs in the past. They worked for Google or Uber, and they're currently at Harvard or Stanford. I mean, they're all amazing people, and so what ultimately comes down to often is actually this question of culture. How well do they fit in with us? And so the process we've created is one where literally, and we're a small team here, we're like 50 people, every single person is going to talk to every single candidate that we like. So the principals and the analysts will do a first pass to see how well, how entrepreneurial they are, what their ambitions are, whether they fit, but also maybe it's cultural fit more than anything else. Once we talk to them, there's the evaluation part where we're asking them to pitch us like investment ideas in companies that we have invested in, or companies that we should be building, or they should be building, just see how they think. Most of those are actually pretty good. And then it's a question of like, who do we jive with best? And so this year we got 4, 2 girls and 2 guys who, seem to be amazing.
Yeah, so that is a 50-50 ratio of men and women, which is very rare in tech in general. What advice would you have for women or minorities who are in tech to be, to get to be more of a fit, or to be seen as more of a fit, which has often been a challenge?
Well, first of all, there's historically been a top of the funnel issue. So not enough women went into computer science to begin with. And you can't start learning computer science when you're in college, because by that point, I started coding when I was 10. I've been coding for 8 years, and so if you start at that point, we're just not going to end up at the same outcome with the same outcomes. So right now we're seeing every year we have 20% of the applicants that are female, and we're actually trying to make a proactive effort to get more in venture and with us. And because sometimes we were having ridiculous conversations. We're evaluating someone creating a vertically integrated fashion brand targeted at women, and old men around the table are like, okay, this doesn't, like, we don't have the information to make the right decision-making processes. So in terms of, but to answer your question specifically, beyond the top of the funnel issue, which is little by little being addressed. I mean, the most popular class I think this year at Princeton inaugurated in '92, in '96, like started in '92, is computer science actually. So and more minorities and women are going in STEM in general right now. So the top of the funnel issues being addressed. In terms of cultural fit, the answer it's harder, more nuanced because it really varies on the place. Like we are tiny, and I mean we're like 8 investment people basically, and we're really nerdy, quirky, and so we read sci-fi, and so this is what works here because our approach, we're curious about technology and tech trends, etc. I'm sure other places have other things that they value and that they care for, but the reality is there are a lot of nerds out there and of every sex and every ethnicity, and it's great. And we're actually majority non-Americans.
Oh, that's interesting. I mean, I think that we're going to get into a little bit more of the talk about global investments. But first, we have a question from Facebook Live. Ted asks, which sectors and themes are you most excited about over the next 10 years? We were talking before, and you said if you tried to predict 2018 in 1997, you would have failed. So what's going to be good 10 years from now?
No, first of all, I don't think, I think a lot of what has happened in 2018 relative to 1997 is actually reasonably predictable. Where I think people would have failed is like thinking the implications on society at large. I think many people have said was a negative impact of like the destruction of all these jobs, which hasn't happened. In terms of the trends that are happening, I mean, the reality is as Jeff Bezos likes to say in his letter to shareholders every year, we're at day one. We're at the very beginning of the tech revolution. Only 10% of commerce is online. When you look at every major industries, like public services has not been disrupted yet by tech in any way, shape, or form, and that's like 30 to 50% of GDP in most major OECD countries. Healthcare has not been disrupted by technology. Education has not been disrupted by technology. And even if you look at industries that are starting to be disrupted, like food, you only have the ordering part disrupted, but like not the production, distribution, etc. So basically, we're still at the very beginning of the tech revolution, and everything is yet to be done. And now the trends that I like the most these days, historically we've been marketplace investors, and I think marketplaces are actually still the things that speak to me the most, because you take markets or businesses that are opaque and fragmented, where there's no transparency on pricing, and you create an amazing user experience with liquidity and transparency. Now, more specifically, I would say that happens in the most interesting areas, probably in the B2B world, where a lot of things that have happened in the consumer world have not yet happened in the B2B world. So if you're trying to buy petrochemicals, historically what would have been done is you're a guy and oh yes, I think I know the supplier at Dow Chemical, I think they kind of do this, let's call them. So it's Rolodex or Excel or email, and now you actually have marketplaces that can do this, and we're seeing this disruption happen in everything from like hiring dump trucks to scrap metals to doing logistics like Flexport, etc. So there's this massive trend that is mostly invisible to most consumers because they don't see what's happening in the back end, but actually is creating massive efficiencies in supply chains, and bringing the deflationary power of technology to bear. So ultimately, it'll reflect itself in the consumer world by lower prices, by better user experience, by lower turnaround time. Now, in terms of maybe societal disruptive changes, the arrival of self-driving cars is going to be absolutely monumental, because every year right now, we have, at a global level, 50 million car accidents. We have 1.2 million deaths. Now, that's going to go to zero. You actually can't make predictions to whether or not demand for cars is going to go up or down. You can say, I can make a case for both. Right now, average car utilization is 5%. Peak utilization, which is like a rush hour on a Friday, would be 25%. So you're like, oh, we don't actually need all these vehicles on the road. Maybe car sales divide by 4. But no one really knows what happens with demand when the costs of an EV basically divides by 10. And so the elasticity of demand may be such that demand for transportation explodes if transportation itself is really, really inexpensive. So in a world, for instance, where, so right now, I'm not going to order an Uber Eats or Postmates a coffee, because the coffee might be $1, but the delivery might be $5. That doesn't make sense. But in a world where a self-driving vehicle, it won't be a car, but an autonomous vehicle or a drone, delivers you the coffee in 5 minutes, maybe all of a sudden you start ordering things a lot more, maybe even a Coke. So maybe you don't even have a fridge. Maybe you don't have a kitchen because the cost of real estate is so high in these major cities. If all of a sudden I can get food delivered for free that's great quality in record time, it may actually lead to even fundamental changes in the way we consume food or goods and the storage that we have. And I can think of a lot of these other second order impacts. Maybe you no longer need gas stations, and therefore you no longer have 7-Elevens, and you no longer need parking spaces. And so what does that entail at a societal level in terms of like what are interesting investment thesis? So that's going to be a revolution. It's going to happen. It's going to start happening in the next few years. But in terms of like the real impact at the societal level, it's going to take more 5 to 15 because of it'll take a while for self-driving vehicles to steepen the world. Because every year right now in the world we have like 2 billion vehicles. The annual production of cars at a global level is like 100 million. So even if we were only producing self-driving vehicles at 100% capacity today, it would still take 20 years to replace all the vehicles. And of course, it's going to take time. First, it's going to be in the higher end vehicles. Then, as the costs go down, it'll start seeping through.
Right, and there's also a challenge with self-driving vehicles as an example of a technology where it needs to be tested, and it needs to be tested in real-world ways. But as we've seen so far, the early tests have been a little problematic. So what are the best ways, if you have a technology like that, to make sure that it gets tested in a real-world way and that it gets regulated properly?
Sure. I mean, the thing with self-driving vehicles is when it's not like voice recognition, or frankly, you need 99.999% reliability. Given the number the number of rides that people take per day, even at 99% reliability, that remaining 1% is actually hundreds of thousands of deaths. And so you want to get to enough nines of reliability in a cost-effective fashion. So frankly, the way they've been doing it kind of makes sense in terms of like creating a framework where you can test it in a real-world environment. But it clearly goes to show that some people like Waymo seem to be way ahead of Uber in terms of self-driving technology. I'm going to non sequitur a little bit here. There's actually 2 interesting battles in the self-driving car world in terms of how are we going to have self-driving cars. Most people have chosen the LiDAR way. You put a LiDAR system, which is rather expensive in terms of mapping out what is around the car. Tesla is doing a completely different approach where they're using essentially low-cost webcams and interesting AI in the back end with powerful GPUs to see if they can have the same efficiency. And now, LiDAR today is more effective, but ultimately, if Tesla's way works better, they'll have a much cheaper, or works just as well, they'll have a much cheaper solution. So that battle is going on. It'll be interesting to see who wins.
One of the things too about sectors like that is that we're also seeing that in areas like currency. So Teal, who asked the initial question, who didn't get to this, but I want to ask you about this. Bitcoin, cryptocurrency, blockchain, it's kind of sweeping the tech world right now. You've seen it take over not just the news, but also company creation. Companies coming up really, really fast. So what's your opinion on that? And do you agree with what people say, which is that Bitcoin or cryptocurrency now is where the internet was in 1969?
So what's interesting is if you live in the West, right, you don't necessarily understand why you need Bitcoin, right? We have functioning legal systems, we have respect for property rights, we have currencies that work well, but some of the last companies I built were based, the back office were in Argentina. So I built the largest classified site in the world, a company called OLX. It's like 3,000 employees in 50 countries with like 300 million users. We had like 500 people in Buenos Aires. Now, if you lived in Argentina over the last 20 years, you suffered through forced conversion of your dollars into pesos at a bad rate. You saw the nationalization of your pension assets. You saw fake inflation statistics where basically whatever you owned was inflated away at like 30-40% a year. And then you saw a artificial fixed rate of exchange between the dollar and your currency, which was like a fourth of the actual market price. And so you saw massive confiscation of all of your assets. So if you live in countries like that, or in places where there's no capital conversion from your currency to another currency, you see a real value in having crypto assets, because the alternative to them would be diamonds or art or gold, but like those are like cumbersome to own, they're easy to get stolen as well, et cetera. So, and it's not surprising in a way that a lot of the early crypto proponents have been actually Argentine entrepreneurs, like Wences Zappo, or people in Russia or China, where there are capital controls. You don't have an easy way of getting your currency out. But I guess the meta. So first of all, there is a logic and a reason for things like Bitcoin exists, and the meta trend of like, oh, there is something interesting to be done with decentralized, robust networks at a global level, I think is true, but not necessarily true the way the crypto enthusiasts would say in every single category. So centralized marketplaces do have a role to play. If you're, to me, it's great that Uber is actually vetting the quality of the drivers, and that they've actually created liquidity in the supply and demand side, or that Airbnb is offering insurance for the sake. So if an existing centralized marketplace exists and is doing a good job, I'm not sure there's any logic for it to be replaced. But if one does not exist, where there is no tracking of ownership, where there is no centralized registry, where then it might make sense for one to be created. So one of the companies we invested in, for instance, is a company called Codex, or Codex Protocol, and what they do is they track the ownership and authenticity for art on the blockchain, because that actually doesn't exist. And so this way, you know that when you buy a piece of art, it's authentic, and you know who owned it, at what price it traded. It also allows you to use crypto to buy a new asset class. And so those types of projects, I think, make a lot of sense, because they're not replacing existing centralized platforms that already do a reasonably good job. Now, there are centralized platforms that don't do a good job that should be decentralized or replaced. So, but are we at the beginning of a new revolution in decentralized systems? Yeah, actually, probably true. Though, will it take over the world overnight? Probably not. I mean, we're still at the beginning of the hype cycle. And frankly, when you think of like the consumer applications out of crypto, we're actually years away. We're still, most of the companies that are interesting that are being built right now, we're actually building the building blocks for building upcoming scalable consumer applications in crypto. So we don't really have, actual consumer-facing applications with crypto. We're not going to see any for the next few years. And a lot of the fundamental basic things are still not built. I mean, there's no effective custody system right now. Like if I went and bought 10 million of Bitcoin, if you leave it on the exchange, that could get hacked. Someone could hack my account and steal it. If I try to self-custody, that's reasonably complicated. And I could lose that key or passphrase. And I mean, so a lot of things that are still simple in the regular offline world are now still complex in crypto. So all this will get addressed over the next few years. But yeah, are we at the beginning of an interesting wave of development in the crypto space? Absolutely, and it's a meta wave that I actually think is interesting, and a lot of people should participate in.
Yeah, it's been really interesting. My background is covering Wall Street, and it's been really interesting seeing the heads of banks and so on really resistant to crypto and messing with currency, whereas they would have embraced derivatives or other kind of structures. There's something a little bit threatening, I think, about crypto,
of course.
And you hear a lot of it in claims right now that there's going to be a crash of some kind, which, it's not a market with a tremendous amount of liquidity, so it's, there aren't a lot of people who own crypto or who trade crypto, so it's hard to see that happening. But what do you think of a crypto crash influencing the rest of the economy?
Well, first of all, arguably there's already been a crash, right? Like the total value of crypto assets is divided by 2 in the last 4 or 5 months, right? BTC went to over 20K. I think we're at 8 or 9K right now. But do I see this as having greater implications for the rest of the economy? Not really, frankly. It's not as though this has been the extra capital that's been driving the world economy in any way, shape, or form. And a lot of these assets, it's not as though they have a lot of the crypto owners actually come from countries with capital controls, right? So if you're in China and you have a lot of crypto, there's no great outlet for you to actually, you can't go and create an account at Coinbase. You don't have a US account at like JP Morgan. You can't then go and sell your BTC in exchange for USD that you put in a US account. And so because that outlet doesn't exist, what these people do, the easiest thing for them to buy is actually other crypto. And so it's part of the things that has been fueling the ICO bubble is massive crypto owners looking for diversification. The problem is, by virtue of being a country with capital controls where there's no assets they can buy with a crypto, they buy other crypto. And by is that crash, and a lot of those ICOs are really fraudulent, and I mean there's nothing behind them. Does those going to zero mean anything? Probably not. Now, I would not recommend anyone actually put real money in their savings in that, and we should make sure that doesn't happen. But given that the people that were mostly investing were the crypto whales who are massive BTC holders from other countries with capital controls, I don't think it makes a big impact if that goes to zero or they get hurt.
Mm-hmm. So you've touched upon a few countries now, Argentina, China, a few others. You do business pretty much globally, right? So what countries do you do business in?
Well, if I look at FJ Labs, so first of all, we're primarily investing in the U.S. I mean, we're 70% U.S., 70% of the investments. The U.S. remains the place with the largest market, the most liquid, the most interesting, and especially as a non-Chinese individual, where you have respect property rights, you can succeed, etc. We also do 20% of our investments in Western Europe and in the Nordics, and then 10% these days in Brazil and India and a little bit of China. But that changes over time. It used to be a lot more emerging markets until the political decisions that these countries made, especially Turkey and Russia, and at that time Brazil, I felt were going to lead to macroeconomic consequences that were going to be negative, which was going to lead to microeconomic consequences that were going to be negative. So we went from 50% Brazil, Turkey, Russia to essentially zero, like 7 years ago, and it was definitely the right call. And frankly, if you can invest in the U.S. and invest in innovation in the U.S., I mean, why do it anywhere else? And we happen to be opportunistic, and so when we see amazing deals in Brazil or in India or in Western Europe, we do them. And also by virtue of having built very large businesses in India and in Brazil, et cetera, and being French, I see a lot of interesting deal flow from these countries, and there are a lot of interesting deals happening there. So we actually still invest there, but the real focus, frankly, is the U.S.
Mm-hmm. It's interesting because you've said before that you like to invest in Nordic companies because their home markets are so small that they naturally think globally, right? So they probably have some skill for scale, which arguably U.S. companies don't think globally as often, right? They scale up less fast.
No, but I don't want U.S. companies to go global, actually. Mm-hmm. My recommendation to U.S. entrepreneurs is don't go global because it's highly distracting to go to another country. I mean, you open another office, there's different time zones that people to manage. They're not here, and if going to the UK decreases your probability of winning in the US by 5%, it's not worth it. I mean, let me put it differently. If you're in the US and you're doing $100 million a year in revenues, it's easier to go from 100 to 200 in the US than 0 to 100 anywhere else. If you're at $1 billion, it's still true. If you're at $10 billion, it's still true. So the threshold for going global if you're a US company is really, really high. I mean, it means that you need to have really exhausted the US opportunity, and usually once you've won in a category, you find tangential categories that are more interesting. So frankly, my fundamental recommendation for most entrepreneurs in the US is don't go global, because it's easier to win here, it's much bigger, you're going to be worth a lot more from a valuation perspective anyway. If there are other people that copied you, and it happens sadly, well, it's okay, you can buy them, and you can buy them typically reasonably cheaply. It's way easier than actually trying to go and execute. So the US in itself is so big, there's no point of going global, actually. Now, it's different if you're a user-generated content site, right? So if you're a Facebook, yeah, absolutely, or Wikipedia, yeah, obviously go global. But if you're an Amazon-type business, if you have like supply chains, logistics, payments, inventory management, I mean, those things are really local and really complex. For the most part, I would say don't go global, and for a very, very long time.
Mm-hmm. And part of that that startups have to think about, of course, is political risk, which you've touched upon in countries like Brazil and Russia. What does a startup need to think about in terms of political risk, even here in the US, but also overseas? What political conditions does a startup need to grow?
What startups, and frankly businesses in general, crave the most is frankly stability. A stability of the rules, and stability of the system. So, taxes could be high or low, labor laws can be restrictive or not, but like, as long as they're understood and we know how to deal with them, then it's okay. Now, obviously, in general, you prefer to have flexible labor markets. In general, you prefer to have deregulated markets in which we can operate. This way we can attack incumbents without fear of retribution or without needing licensing, and you prefer reasonably low tax environments. But frankly, the stability of the rules is more important than what those rules are in general. I mean, assuming you're in markets with the respect for property rights. Now, if whatever you have can be arbitrarily confiscated away. That's different. But the, and historically, but when you want to succeed, if you're thinking internationally, it's more than that. You also need to think of like access to capital. The reason we don't invest in small countries other than the Nordics, because they build global companies, is because most of these countries don't actually have robust venture capital markets. So if every country in the world has angel investors, you have successful people who've made money, who are happy to give you the first million. The problem is if you're in Chile, first of all, you're building a small business, but then there's no Series A money available. There's no Series B money available. Now, if for whatever reason you break out, you become very successful, Sequoia, Tiger, and Andreessen, they will find you. So there's a company in Colombia called Rappi, and they're crushing it. And they're doing like hundreds of millions in GMV. They're like an Instacart meets Postmates or Uber Eats, meets many other things for Latin America, based in Colombia. But because they've reached escape velocity, the late stage people find that. The problem is in the middle stages when you're raising your A and B, there's a real Series A, B crunch in most countries outside of the US and China. And capital is not available, so you can't really grow, so you can never make it to the escape velocity. And so that's a problem for most people. Now, if you're a US company trying to expand elsewhere, obviously you want to expand to places where it makes sense for your market, in terms of like there's demand for your product, given your product market. I mean, most people are going to expand to the larger countries, right? So you're going to do UK, Germany, France, where probably, and then probably after that you do, I don't know, maybe Brazil, China, India.
Mm-hmm.
Yeah.
And so when it comes to companies kind of getting off the ground, one of the things that you've said that I thought was really interesting was that you don't want to give a company the first money that it's ever had, right? You want people to raise their own money up to a couple $100,000, show that the concept can exist before they go out to angels. Do you still believe that?
We've expanded our definition. We now do pre-seed because also what is the stages of venture capital have been changing and people have been raising more money. But I do like it when, with very little capital, but let's say the fool's friends and family money, the entrepreneurs, and that's like 100K or whatever, have actually built something. It's actually cheaper to build something today than it's ever been before. When I built my first startup back in 1998, we needed to like build servers and buy Oracle and Microsoft licenses. I mean, just getting out of the door, it costs a couple $1 million. Mm-hmm. Today, because of AWS and everything's open source on MySQL, PHP, or other stacks, you can build almost anything for nothing. I mean, if you know how to code, and if you don't know how to code, even like 50K, I can build you almost anything. And so I'd like you to be able to have shown something that you can build with very little capital. Goes to show that you're capital efficient, that you're frugal, that you know how to get it done. I don't like paying people or giving money to people to build something. I want to give the money I invest, I want them to build the business with. So I wanted mostly to go into things like marketing or sales, not into building the product team. I'd like them to have been able to build a product with very limited resources.
Interesting. And so when it comes to entrepreneurs who are in that very young stage, one of the things that they often struggle with is negotiation tactics, right? And when you're building a company, you can often feel quite desperate to get any money in the door, and maybe you don't negotiate as hard. What would be your advice to entrepreneurs just starting out about how to handle those first negotiations about money coming in?
Well, there's a pretty established venture cycle and a pretty established sense of how much you're raising at what stage and what valuation. So if I look at the businesses that we invest in, both in e-commerce and marketplaces, the pre-seed round, so you're just live, baby, you have the product ad, but maybe no revenues or 10K a month of revenues, you're going to raise 1 million at like 3 to 5 million pre. And with that, I expect you to get to 200,000 a month in sales, and 12 months later. 12 months later, you're going to do your seed round with that type of numbers, and you're going to raise 2 million at 8 million pre. And again, there's a band around that, but more or less. And with that, I expect you to get to 500K to $1 million a month of GMV, of gross sales, and you're going to raise 5 at 15. With that, you're going to get to 2.5 million a month of GMV, and the next round, your Series B, you're going to raise 15 at 50 or 40 or something like that. And so, given that there are ranges and expectations of what is the market, just make sure you need to make sure that what you're asking for is in line with what the market is willing to offer. So the problem is if you're building a company and you need 50 million up front, it's not a venture backable company. It doesn't fit in the mold of what we're looking for. So it's good that your capital efficiency and requirements are in line with what the market is willing to offer, and then just do your homework. Like, know what are the typical market terms and ask for what things for those market terms at the life cycle of your company.
Mm-hmm. And now, one of the things that used to be pretty common in the past, but because of consolidation has become less so, is giant companies, like we used to see Lucent, for instance, invest in younger stage companies and kind of almost create incubators for them. Is that still an option?
I know a bunch of venture funds that are corporate venture funds, but frankly, I find those to be a bad idea for the entrepreneurs. You don't want strategics to invest in your startup in the early days, because when they do that, in a way, you're limiting your exit options. Because even though they don't have a right of first refusal in buying your company, if a competitor of theirs tries to buy the company, they assume that that company will buy it instead. And so in a way, no other competitor wants to bid for that company. And so you end up selling to that strategic for a much lower price than you might be worth. And so I would actually not recommend taking strategic money in the early days, just because it limits your options in the future. Take smart investors. And same thing, by the way, at the seed level, you don't want to take a traditional Series A investor, because if they invest at seed, which is not what they typically do, and for whatever reason they don't do the A, that's a very negative signal that may make it very difficult for you to raise your A in general. And so raise the money from the right people at the right round, right? So if someone is a Series A investor, raise money at the Series A from them. Don't raise money at the seed, because of the potential risk of negative signaling.
Yeah. So we have a question related to what we just talked about in terms of registering a company. Simone from Facebook asks, what would be the best location to register a company that offers digital services worldwide in today's political climate?
I'm clear where those digital services worldwide are, but today, if I'm incorporating a company, frankly, I just do Delaware C Corp. It's what investors, because ultimately you need to think through what is going to be the easiest way for you to operate and where you're going to be able to raise money. And if you have a funky structure, a VC is not going to invest for the most part in a Cayman entity or in a whatever, but a Delaware C Corp where the rule of law is well established, where where the investors are protected, where the companies are protected, et cetera, it is a well-known entity. So there's no reason not to build a Delaware C Corp. Or put it differently, you would need a very good argument as to why it should not be a Delaware C Corp. Now, often for people may start with LLCs and then later convert to C Corps when they actually get professional money, because that's cheaper and easier to maintain. That's also okay. But other than Delaware, you need a very strong argument for why it should not be there.
Yeah, it's very knowable.
Yeah.
So Amelie from Facebook asks, what are the common mistakes entrepreneurs make when raising funds?
When raising funds, in fact, entrepreneurs, they don't necessarily approach the right VCs at the right time, right? So there's no point if you're like a seed stage company, don't approach a late stage VC. So you should know what to ask and when to ask. At the same time, what we expect to see from you is a PowerPoint that's like 15 to 20 pages, presents your idea, presents who you are, presents the traction, etc. Don't send me a 50-page vertical business plan. That's not the way we work. So just know what the other side, the VCs, are looking for, and present in an environment that's digestible, or a format that's digestible to them, and that is what they expect. And so if you're pitching a marketplace VC, a marketplace at the right stage with a PowerPoint that makes sense and tells that it's a compelling story, that's fantastic. But it's often not what we receive. I mean, every week we get 100 deals. Frankly, 60 are out of scope. Like, we're getting biotech and space tech and green tech and agricultural tech. I mean, it's hardware stuff. I mean, it's amazing. It's just not for us. It's not what we do. And so for us, it's like thanks, but no thanks. Or people that are like, oh, I have this great idea. I need money to build it. Like, that's also not what we do. If you have this great idea, you've built a team, you've built the product with your own resources, and now you need money to scale it, that's what VCs want to invest in.
Mm-hmm. And I just want to say to the Facebook audience, we have 15 minutes left, so if you want to get your questions in, get them in now. So one of the interesting things about how you invest is that you take passive investments. Is that right? You don't get involved in the companies.
So Yes, so we don't take board seats. We don't actually write the term sheet. We don't price the rounds. But we're active in a different way. The funny thing is, if you ask most of the entrepreneurs that we back, if they who would be the most helpful VC, they might actually say it's us, even though we're not on the board and we're not active. I find that boards have often destroy value because it becomes a reporting engine where like it creates work for the entrepreneur. The entrepreneur needs to prepare these decks to tell the board where they're at. And that's not really strategically interesting. Where I find that I get more value to the entrepreneur out of like having a coffee chat for an hour, talking about what issues he's facing and seeing how we can resolve them. But maybe the way we've decided to specialize, I mean, there are funds out there that are multi-billion-dollar funds, and they have like headhunters, and they're going to help you recruit, et cetera. But like, we're not that. We don't have the resources to do that. So we realized, okay, what is it we can do that helps the entrepreneurs the most? And frankly, it's fundraising. If you're an entrepreneur, you're always fundraising. You're always selling. You're selling the press. You're selling business partners. You're selling employees. You're selling investors. And frankly, you're always fundraising. You may have just closed your fundraising. You're still fundraising for the next round. So what we realized is we're really good at helping because the way we work, because we're not leading and we're not pricing, we don't compete with traditional VCs. So we actually work hand in hand with like Greylock and Sequoia and Andreessen and General Catalyst and Bessemer, and we send them our best deals at the next round so they can fund them and vice versa. So they're very happy to see the deals that we like, and they're happy to share their deals with us. And so what we do for entrepreneurs is we help them fundraise. We will help them work on their deck. We will make them the intros to the relevant VCs at the right time. And that, in a way, takes relatively little time from us, but it's massively value added to the entrepreneur because they get their Series A or their Series B funded from the very best for the very best VCs. And so that's the main way we help companies, even though technically we describe ourselves as passive investors because we're not on the board, because we're not taking a role where we actually even expect reporting.
Mm-hmm. And so how do you arrange that? How do you, get your time with the entrepreneurs since you don't have a sort of a formal, board seat or anything like that? And when you do have coffee with them, what do you talk about? How do you draw them out and how do you evaluate their problems? Because sometimes people don't want to talk about all the problems they really have with their companies.
Sure. So whenever we invest in a company and on a regular basis, we make our portfolio companies actually fill in a type form where they tell us how much cash they have, how much they're burning, where they're at traction, and when they want to go out and raise. And so we make sure that 6 months before then, we reach out to get an update and to proactively help them on the fundraising side. So it's kind of automated. The same way we've created tools, totally like outsourcing things, we've created tools to manage our portfolios, to manage our deal flow, and so using all these tools to automate a lot of these processes. Now, in terms of the reality is, ultimately, we're more reactive than proactive. So the entrepreneurs we tell them we can help them, but and a few that we think do really well, we proactively try to help them, but that's maybe 20 or 30 companies in the portfolio. The others, it's more, if you need help, come to us, and we will help you. And so it's not as though I'm trying to draw them out, as they need to draw themselves out and realize, okay, I need strategic advice. So, should I be selling? Should I be investing more? Should I be raising right now? I'm facing this issue, this competition, or these employees. So we're more reactive. So, but some people use this a lot as resources, and some people don't.
Yeah. One of the things that weighs fairly heavily on entrepreneurs and on founders is the fear of failure. And there's been kind of a big cultural move against destigmatizing that, right? Fail big and move on. But have you found that there are entrepreneurs or founders who have failed and that makes you wary of working with them again? Or is there a particular way to fail that is the wrong way to fail?
It's so actually it's more the opposite. If you failed in the past and you can prove to me that you've learned your lesson, you were not careful enough with cash and you were too aggressive. You thought it was a land grab, whereas in fact it made more sense to focus on the unit economics. So if you failed and you've learned your lesson, I actually think that's great because you've learned someone else's dime, and now you're ready. You're ready for your second round. And often these people have a chip on their shoulder and they want a shot at redemption. They're going to work doubly hard to make sure that they don't fail. So now, if you fail because you were incredibly arrogant and tone deaf and didn't understand what was going on, and continue to show the same traits, and you don't seem to have grown or learned from that experience, then of course that's a sign that you probably shouldn't be an entrepreneur, and we're not going to back you. So the question for us is always, have they learned something from the experience, and does it make them even hungrier to go succeed? Which for most people it does, actually. And so for most people do learn from the experiences. And so we have a lot of failed entrepreneurs, because you can fail for a whole variety of reasons. You can fail because there was no product market fit. There was too much competition. They had way more capital than you did. Or you made a few fundamental mistakes in execution, but you understand what those are. Or frankly, you had a falling out with your co-founders, but now you understand the importance of culture and who the right fit is for you, et cetera. So all of those are valid, and it's okay.
And if they do want to get started again, one of the things that has become almost a popular genre is the medium post, in which a founder talks about their experiences and kind of presents them, and part of the function of that post, of course, is to explain their mistakes, but also show that they're willing to take risks again.
Yeah.
What is your opinion of those? Is that a good move for founders to do, or should they keep it to themselves and just talk to VCs?
To be honest, I've been paid attention to that trend, so why not? I think it's probably helpful for people to share and put it out and let it out. So I love writing. I mean, I write a blog on a regular basis just because I like to share. And so I think for most people, it's like lifting something up. It's kind of meditative and therapeutic in a way. So it probably makes sense for them to do it. But yeah, no, I have no specific opinion as to whether it's a good thing or a bad thing. I'm not aware of them, nor was I reading them. So.
Well, one of the questions that we had on Facebook was about a couple of sectors that I think you've spoken about. One is education, which you said was ripe for disruption. Another one you haven't spoken as much about is esports and healthcare. So a lot of these are sectors that are very specific, very niche, but it sounds like things might change, that they might become bigger.
Well, I mean, first of all, the sectors per se, esports is still reasonably, well, it's actually not even that niche anymore, but no, education is 10% of GDP, right? Healthcare is 28%, well, 18% of GDP. It's not niche at all. It's niche in the technology sector because there happens to be, there's a massive public involvement in the space, they're highly regulated, and so the way people attack them is tangentially or at the edges. People would build in education, they build educational iPhone apps or iPad apps, or they build things like Linda, which is it's continuing education online, and so or you create like these little courses like Udemy or Udacity where you can learn different skill sets, etc. So there's been and all these are reasonably large already. What has not been attacked today, frankly, in a pretty effective way, is the main way in which we educate people, K through 12, or university education. And in fact, it's one of the shocking things, because if I take Socrates from 2,500 years ago and I teleport him by magic in today in New York in 2018, most of the things in the world you would not recognize. The fact that we have like wireless transmissions, that we can fly, etc. Like we might as well be aliens for him. But the way we educate our kids, which is we have a teacher of varying quality spewing, standing in front of a classroom of like 20 to 40 kids and spewing facts at them, actually is something you would recognize, because that's kind of the way we were teaching our kids 2,500 years ago. And I would like to think that there are many ways we can do this better in light of all the technology and the tools that we have. And it's going to take a while because of the nature of the space and the fact that it is regulated, that a lot of it is provided by the public sector. But there's a lot of innovation going on right now in class format, in maybe changing the role of the teacher from the fact spewing machine to maybe the consultant that helps the kids who are being taught by software, et cetera. So there's a lot of innovation going in the space. Because of its regulated nature, it'll move slower than in categories that are not regulated. But it is ripe for disruption, and there are a lot of interesting things happening.
And how about healthcare? It's stunning to me that healthcare doesn't have compatible software systems just across the industry. If you go to one doctor, they have to log into a whole other thing. They have papers and things like that.
It's annoying. It's the legacy of the U.S. system. The fact of the way we've been building. It's the legacy of a lot of things. It's the legacy of the World War II laws, which we had wage controls, and so we started passing. So the employers started lobbying for healthcare benefits to be tax deductible, and that's why we moved to corporate provided healthcare, which doesn't make sense. We should be the only consumers of our own healthcare. Now, in terms of like the way the payment systems work and the way the technology works, it's a legacy of our frankly archaic system. If you move to a country like Estonia, everything is automated. So in Estonia, all private and public healthcare systems, medical records are online. I book my appointment online. I go to the doctor. I just type in my social security number and password. They get access to my medical records. If they write a prescription, I go to my pharmacy. I don't have a piece of paper. I just type in my social security number and password. They know the prescription. I pay whatever my copayment is, and everything else is paid automatically. It's all automated. It's also true at the school system. So all school records, public and private schools, are online. So all communications, teacher, parent, teacher, student, all grades, all attendance records, everything's online in a centralized system. Now, it's easier to do when you have centralization. The issue is in a country like here, which is highly federal and decentralized. You have different rules, different systems everywhere. So it'll take a while before you can create a meta layer where everyone's connected, where all the medical records are online, et cetera. I mean, it's clearly the trend that things are going to, but it's going, given the nature of the system, it's going to take a long time.
Yeah, and one of the barriers is, or perhaps not a barrier, is this movement towards data protection, right, that we're seeing in Europe, but which will probably be imitated in the US. What are the right parameters for something like that?
Well, if you put it or structure it the way that you are the owner of your data and you can share it with whomever it needs to have access to it, then it makes sense, right? Like, so the medical records are yours, and then you share it with the relevant medical practitioner and the relevant insurance company in Estonia, at least, on a per needed basis, right? So maybe your specialist, your eye doctor doesn't need to have your entire medical history, but whatever is relevant to that, you choose to share it with. So you actually pick what is shared with whom, and that model seems to work reasonably well. So a model where you own your data and then share it with whomever you want in the medical field makes sense. Now, the interesting thing on the data thing is, most people, the data thing, it seems to, on Facebook, it seems to be overblown, because if you ask people, would you be willing to pay $4.99 a month for an ad-free version of Facebook where you own your own data? The answer seems to be no. Whereas, and so people don't seem to be valuing their data that highly, and so ultimately people seem to be willing to give away their data in exchange for having Google and or Facebook to be free.
Mm-hmm. And I think they're just realizing the parameters of that as well. So, well, thank you very much. This has been a very broad conversation. Learned a lot. Thank you, Fabrice Grinda.
Thank you.
And thanks everyone for tuning in and for listening. And keep up the conversation in the Facebook comments.